Welcome to Sierra Capital's Family Office Fundamentals, a podcast dedicated to helping families preserve their legacies and wealth for future generations. I'm your host, Zev Zaretsky, Investment Director at Sierra Capital, a 25-year-old multifamily office focused on guiding ultra-high net worth families globally. In each episode, we'll explore a wide range of topics, including investments, trust and estates, family governance, philanthropy, and much more. Our goal is to provide you with a solid foundation to safeguard your family's financial, intellectual, and human capital for generations to come. Join us on this journey and stay tuned as we hear insightful conversations with industry experts and thought leaders right here on Family Office Fundamentals. Let's embark on this journey together. Please find important disclosures at the end of this podcast. All right, well, thanks for joining us today. Today's guest is Michael Rubel, a partner at RFE Investment Partners, where he's been since 2009. Mike brings a strong background in private equity and M&A with prior experience at Weston Presidio and Harris Williams. He earned his MBA from Duke and his undergrad from James Madison University. So we'll be talking to Mike about RFE's recent successfully executed succession plan, as well as the firm's strategy and longstanding history in the lower middle market and history in the SBIC program. Let's get to it. Look, thanks for coming on the show. I really appreciate your time and look forward to the conversation we're going to be having.
Thanks for having me. Good to see you.
Absolutely. So to kick things off, I was hoping that you could share a little bit about your general background and work experience that brought you to the buyout space. Obviously, everyone wants to work in private equity, but yeah, also just private equity in general. What kind of led you to lower middle market?
Sure. Yeah, I appreciate that. So I actually kind of grew up as a public market junkie. I was all into the stock market and company analysis through that public market focus. But late in the kind of recruiting cycle in college, I was all set to do kind of equity trading, but found a lower middle market advisory firm, Harris Williams, that did M&A for small companies, and so kind of pivoted to that. Great culture, great firm, and kind of fell in love with helping small companies. And as most investment banking analysts do, I looked at private equity coming out of my 3-year stint there and found Weston Presidio to be a good match. It's a firm in Boston, headquartered in Boston and San Fran. But bigger deals, kind of a more diversified type of PE strategy at the time. Did a lot of like control, minority, venture, growth equity, kind of more of a diversified approach, which was cool and a good training ground. So went to business school, went back to Weston Presidio as a principal, and then in 2009, Weston just announced they were going to probably postpone fundraising, and my fiance at the time announced she didn't like Boston because she's a New Yorker, and so I kind of started looking around for, what do I want to do with the next kind of chapter of my career, and I really wanted to go to the smaller part of the market and do control-only deals. And then the guy I met at Weston, Paul Schilp, we started together in 2003. We kind of saw the world the same and kind of clicked, and so we linked up and said, do we want to start our own fund? We're kind of green. We were probably 30 at the time. Or do we try to find a platform that kind of fits what we want in the New York area? I ended up finding RFE in 2009, 16 years ago. And RFE had been doing small buyouts since the late 70s. So kind of a long and loyal history to the small market, which is cool. Great people, great culture. So joined there as a principal and been here ever since. And Paul joined a few years later. He was at Merrill Lynch's mega cap fund doing huge deals and sort of had to wind some stuff down there. So he joined RFE about a year and a half after I did, and it's been a great run.
Oh, so you joined the firm as a principal back in you say you're in your early 30s, or?
Yeah, I think I joined, I was about 30 years old. Yeah.
RFE at that time, what was the hierarchy and kind of structure of the firm? Was it pretty flat?
Yeah, they had a couple of senior partners and then actually kind of a void at the middle part of the firm. So I kind of joined as a lone wolf, kind of mid-level execution guy. And then Paul joined right next to me. And as we progressed, we kind of wanted to kind of finish our careers here. And so got with the kind of the powers that be and mapped out kind of a longer succession plan. So,
yeah, well, we'll definitely talk about that coming up. But So I guess RFE in general. So clearly a lower middle market buyout focused private equity firm. Um, Given the fact that it started in the 70s, obviously, you weren't there to help drive the change back then, but
No.
um, what's been kind of like the general evolution of the firm? I guess like quickly from the way it started to where it was when you joined, and then since you joined, how has the firm changed? Just in terms of its focus?
Yeah. So I think in the 80s, from what I know, they were doing all sorts of stuff. I think back then it was common to do venture capital, minority, and kind of all different flavors of PE. But in the 90s, they were doing really kind of focused in all on controlled buyout situations in the small market, but a pretty diversified industry approach. I think we were pretty generalist through the 90s and early 2000s. A lot of healthcare, manufacturing, a little bit of tech stuff, and so it was a very broad mandate when we showed up. And so what Paul and I wanted to do as we sort of started to put our mark on the firm was a few things. One was to narrow the industry focus to kind of areas that we felt were, um, played with our past success, were good fragmented spaces with good drivers, and frankly, good areas that I think the upper middle market PE firms would want to buy into as we create these platforms from scale. What will they want to buy? And so Paul and I focused the firm on three verticals, one being home and facility services, second being professional services, and the third being like environmental and sustainability. So one person just said it's sort of like blue collar, white collar, and green. Um, and that's one area I think it's been a blessing because now we can kind of double down on the Rolodex of executives, of our deal sources, our expertise in those core areas, and have a bit of a niche focus without being kind of a narrow sector focused fund, which I know those are great, but we didn't want to go that sort of that narrow.
I guess like for a firm that started in the 80s, I guess it'd just be interesting also, like what is the investor base? Like how did it look back then? And like how has it changed to what it is today?
Yeah, the investor base, I can't speak to a lot of it back then, but the profile was pretty similar to today. I think we've had a lot of endowments, a lot of pension funds, a lot of state retirement plans. We got a corporate endowment. I think family offices has been a bit of a void for us, both historically and now. So it's kind of, I think it's evolved quite a bit. Um, but the broad profiles of the bigger investors is kind of, I think, kind of the same and pretty standard. And
Yeah.
obviously, the banks come in and out with SBICs, which we can get into later. But the investor base, I think, it's just the types of folks has been fairly consistent.
Yeah.
Yeah.
One thing you brought up is your prior successes from your old firm. And so I guess were you kind of working on the same type of stuff um, back in your old shops versus what you did when you joined RFA? And then also if maybe you had a fun little 2 minute story on like one of your best deals.
At our prior shop or here or both?
I don't know, whichever one. Which is
Yeah.
your best one?
Yeah. Yeah. At Western Presidio, Paul and I worked on a bunch of stuff that overlaps with kind of where we're doing now, like a lot of service companies, a lot of build up strategies, and which is kind of why we chose that. I think one of our better deals at RFE was a company called Wind River Environmental. It was a residential septic service company. So door to door, like septic services. So talk about essential services that you don't postpone or defer. You definitely clean your septic when you have to. Otherwise, things get pretty gross. And so recurring revenue and a very nice sort of build up model that really lends itself well to kind of the whole PE playbook of raising prices and raising frequency and cross selling and route efficiency and fleet efficiency and just kind of all the operational and sales type of leverage you can pull. So we did that deal in 2014 maybe, and sold it a few years later. Did about 15 add-ons, and then bought it well and sold it very well to another PE firm. It's actually coming back in the market, I think. But that was one that kind of, for the quick story of the success, that kind of we always say it's never a straight line to the right, but that one kind of was a straight line to the right. It kind of worked out nicely from start to finish, which is not always the case.
Yeah. Well, I guess we'll touch on the current structure and what you guys will be looking at. But I think it's pretty cool story what you have, because a lot of firms, started 20 years ago. They have to be thinking about succession planning, or they have been thinking about it. You guys went through it, right? So you had the old leadership team has stepped down. You guys have taken the reins. I guess maybe if you could talk a little bit about that transition, lessons learned, kind of think of me as talking to another fund manager who is thinking about going down that route. Because, some people, they sell to a bigger firm, or they take external capital. Like you've seen insurance companies going into the space. I think you guys did it all internal, right?
We did, yeah, and happy to get into that a bit. So we're fortunate to have a very kind of amicable and orderly and sort of slow transition, which was kind of by design. And so I think in terms of advice for other folks going through it, first I would say just start early and make sure everybody's aligned on the general picture of like, hey, we want to ultimately be in sort of the top seat. Is that something you see? And if we're all on board, let's map out a very long and staged approach to succession. And that's kind of what we did. Paul and I probably got with Mike Foster and Jim Parsons probably 2016, 17, and said, look, we like what we're doing here, and we ultimately want to be kind of the guys, and how does that work? And so rather than rush through it, we kind of did a staged approach where first off, we led all the deals and just got the deal leadership piece figured out. And so every deal RFE's done since probably 2017-ish has been Paul or I. The second domino was fundraising. So when we went to raise Fund 9 in the 2021 timeframe, Paul and I were on the front lines of that, which was great. It's a lot of work, so careful what you wish for, but it's obviously part of the progression of this industry. So we were fortunate to have them, give up a lot of the reins on that in kind of the second stage of transition. And then thirdly and finally, we kind of took all the firm operations and finance and firm management stuff, probably 2023 timeframe, and kind of officially became co-managing partners. And so it sounds like a long row, which it was, but that was, again, by design, and it was a very thoughtful way to go about it that way, because you have a day job of managing these deals, and taking on more responsibilities is not easy, but if you do it in a staged approach, it definitely has a higher chance of success. So credit to Mike and Jim, who are now the co-chairmen, for kind of designing it that way, but it did work very well.
I guess it was just a little bit more work, but hey, that's what you were signing up for anyway.
Yeah, I mean, obviously that's it's part of the gig, right? So
I guess in terms of so you guys are the current leadership. How have you kind of steered the ship differently?
yeah, I think the industry approach is one piece I mentioned. Secondly, I think we are really trying to create kind of well-built platforms for the upper middle market PE firms, which sounds pretty basic, like everybody does that, but we really do think about each deal and each industry as kind of, let's start with the end in mind, and kind of what will our buddies at bigger firms want to pay up for when we ultimately get to the size and profile we hope to get to. You see some deals that are fine and good companies, and you can double it, and it's like, well, once you double it, who's going to care? Like, it's not really a platform that someone's going to get excited about. And so we try to find situations where we think that ultimately it'll sell very well. And so it really is a good lens to evaluate new opportunities through, because starting with the end in mind allows you to think about, assets that will ultimately sell nicely. And part of that is a huge part of that is the management team. And so I think if Paul and I kind of thought about what do we want to be really, really good at, and what are we going to be kind of known for, and I think what we're landing on, or what we're pushing, is kind of all things people, and all things just attracting the right pedigree to these small companies. And I know everybody does this, but I think if we can be better at it and have a better batting average than most on just bringing kind of that high pedigree, perfect seasoned leader to a small build up play, good things happen. It doesn't need to be the CEO seat. It could be a chairman, could be a chief of sales, could be a CFO. We're not about replacing management teams, but we are about kind of shoring up good operators with the right pedigree of executives. And when you get it right, the business is soar, and it's really it's nice to see. And so we have an in-house chief talent officer that Paul and I brought on, and all she does is kind of comb the earth for these types of people who fit our industries, and she helps with kind of searches and recruiting and onboarding and incentives and all things human capital, so that when we build the team the right way, with her leading the charge, the company can sort of take off from there.
That definitely seems like a big value add.
Yep.
You could probably sell that service. has its own
Good.
stand up.
Yeah. And I know a lot of folks do the operating partner thing very well, and it works for most people. Our contention is that, for a small company, operating partners can be a bit confusing, kind of someone who's half investor, half operator. Um, so we kind of think of ourselves as trying to find operating partner talent and pedigree and give them a boatload of incentives to join the company full time and kind of push it uphill from there.
Yeah, I guess let's kind of jump around. Um,
Yeah.
Talking about kind of your guys' focus. So, were there any industries or that you guys have stopped doing altogether after taking leadership, or any type of deals that you kind of stopped looking at, that you guys prefer to move in a different direction? And then also just like what's the general state of the market? Obviously, first half of 2025, super interesting, both public and private markets. You have a bunch of companies that you guys are sitting on that I'm sure you're looking to exit, a bunch of companies you're looking to buy. What does the market look like?
Yeah. I'll start with the first point first. The kind of what do we avoid and what have we learned from over the years? I think where we got in some trouble in prior funds at RFE was really around some technology risks that we didn't quite see coming. We are investing in service companies that use technology, but if you're in a space that can kind of get clobbered by technology, it's not really our game. And so we're really trying to find simple businesses with good proven business models that don't have kind of disintermediation risk through tech or AI or whatever. Another piece, I mean, we had some companies that were pretty global. They had a lot of employees in China and India, some in Europe, which is fine. Now with the SBIC, we can't really do that. But I think for a small company to have that kind of global footprint of employees, it's a pretty difficult thing to manage. And if you hit a speed bump, it's a pretty big bump. And so we try to find employee bases that are a bit more manageable and a bit more domestic, which again favors the SBIC program well. So those are kind of the headlines of where we try to stay away from. And again, manufacturing deals that took a long time to integrate, move stuff around, and just move a bit slower than a service company. That's kind of why we pivoted away from manufacturing. It just didn't have kind of the uh, the agility of a service company with regard to kind of the growth plan and the M&A plan. Um, in terms of the market, anything else on that, Zeb, or no?
Yeah, no, that's perfect. Yeah.
Um,
Maybe let's hop to the current state.
yeah, the current state, as you said, I mean, from a buy side perspective, we're still very busy and seeing lots of opportunities, and it's been fine. I know there's not a volume of M&A out there that people want to see, but for our sheet's fairly full because we're starting very small and we're not a huge shop, so we have 4 or 5 things to chew on, and it's plenty for us. So buy side, I think it's been steady. It's been kind of a good environment for us. But as you mentioned, on the exit side of things, is where I think the broader winds of change are affecting us more. Again, we make a lot of our return through selling things well and to bigger PE funds. And the last couple of years, their appetite for some of the bigger assets is just not what it used to be, and they're on the sidelines. Or if it's kind of a B asset, they'll look for reasons to sort of stay in touch, but not for now type of response. And so, um, what we're kind of anxious for is for the M&A velocity to pick up to the point where the exit horizons and multiples and appetite is kind of back to what we hope it will get to. So, I don't know what I think a lot about it. Like, what would be the catalyst from a macro perspective to get everybody back on the train for M&A and get the numbers back up? What's that sort of certainty lever that we want to read about in the paper? I don't know, but but you got to think that in the next year or so things will start picking up and snapping back. But I don't have a great prediction as to what that will be or what will cause that.
Yeah. Well, look, it's very similar to if you look at public markets, right? You used to dream about being a public markets guy. Good thing you
Yeah,
didn't.
yeah, I know.
Um, but yeah, you look at public markets, right? I think small cap has been if small cap equities has been in your portfolio the past 2, 3 years, you've been underperforming the broader market by a pretty significant amount. So
Yep, yep,
just kind of the lower middle market in general, I guess. Lower middle market, both public and private, just been a little soft. But yeah, to your point, I also don't know what the impetus would be. I think it's really obviously multiple expansion is nice to get, right? It's nice to buy things at a low multiple and sell them at a high one. But look, just keep chugging along at organic or inorganic growth and continue that way.
Yeah, exactly. Control what you can control, and hopefully the market opens up at the right time where we can sell some of these companies for premium values. But who knows?
Yeah. Well, luckily you guys are, structured as a as an SBIC debenture fund, right?
We
So
are. Yep.
so that helps make well, at least it helps some funds, be able to etch out pretty decent returns, even in like just a benign market. So yeah, so you guys have the SBIC debenture fund. This is your fifth fund with the SBIC?
This is Fund 9 is our fourth. So yeah, Fund 10 would be our fifth, correct?
Yeah, so it's your fifth
Yep.
SBIC fund. Um, Obviously, you guys have seen some different changes at the SBA over the first SBIC fund to this one. Maybe quickly explain just the partnership with the SBA, and how that partnership kind of helps you guys both like in fundraising and then just also in general operating the fund, being able to make the firm what it is today.
Yeah, I mean, so Paul and I did not grow up in the SBIC community. Fund 9 was our first SBIC fund, but Jim Parsons, one of our co-chairmen, is really was used to be the Brett Palmer of the association and has been very active. And so when Fund 9 came about, and Paul and I wanted to do a kind of a structure where we can speak for more of the capital and control more of the capital and use less debt, we toyed with kind of having a sister mezz fund, or do we have a sidecar of some kind? And then Jim, urged us to look at the SBIC program as a way to, again, use kind of SBA money for to speak for more of the capital structure per deal. And we were a bit skeptical. It just didn't seem like um, we just didn't know quite, what were the pros and cons. And I think we were kind of thought it would be an administrative hurdle and headache. And I think we've kind of done a 180. We've kind of fallen in love with both the leverage, the community, and just the partnership with the SBA. It's been a fantastic experience. Hence the Fund 10 structure being the same as 9 with the ISBSC license. And so I think a couple things around it. I mean, obviously the leverage is very compelling, but more importantly, it allows us to use a lot less debt at the company level, um, and get our return at the fund level through the juice of the leverage. So our LPs are still getting equity returns, but the companies aren't, burdened with multiples of debt, especially in the early years where it can be tricky to kind of build the team and the foundation when you have covenants and lenders and stuff. And so it's been especially in this environment, it's been very compelling to tell these sellers that we are going to do the deal with no debt out of the gate in the first kind of 18 months, and then we'll layer on, 1 to 2 times senior debt as the company matures. But the SBIC program allows you to do that and not use the company leverage because of the fund level leverage. And so it's a very good risk reward in our minds, and it's just a better way to live for these small companies.
Yeah.
Um,
So, so is that kind of how you structure your guys' deals today? Obviously, like we could look back 5 years ago and maybe it was a little bit different, but so today you guys are over equitizing coming in, and then if you're doing tuck-in acquisitions, then that's when you'll sign up a lender to start tapping that term loan.
yep, exactly right. So we'll when we hit the gas on M&A as the foundation's set, kind of in year one or year and a half mark, we'll then layer on the debt to leverage the capital, but only if we think the business can support it and has kind of the legs under them, both from a team, systems, and kind of financial reporting standpoint. So it's been a good model, and I think on top of that, I think the SBA license, once you explain it to people, to both LPs and to the companies we're trying to court, it does give you kind of a little bit of credibility in terms of, the government did put us through the ringer and looked into our histories, and you can't have any kind of personal or professional noise in your backgrounds and come out with a license. You got to have a pretty clean kind of record and bill of health. So I think it's sort of a side note. It's sort of a nice credibility badge to show folks as to, like, the SBA put us through the ringer and we came out okay, and so we're good guys. So
Well, so two questions for you, kind of based on focus a little bit on banks and banking. So in respect to getting leverage for companies now, what are lenders comfortable with now than that what they either weren't or they used to be comfortable at 3 turns leverage with no assets behind it? You guys are doing services companies, right? So there's not a lot of assets other than AR sitting behind the asset. How have things kind of shifted?
Yeah, I think we see this more on the sell side than buy side because, as you know, we don't really use a lot of debt even in the later years of our hold. We're not gonna max leverage something really ever. But when we go to sell, we want to understand what valuations could be, and so it's a question of like, all right, let's get a pulse of the debt market as to how much debt this asset could or should bear. And to me, it's come off the highs, but it's still pretty robust. I mean, just like PE firms, lenders got to put money to work too, and so they are trying to find their spots. And I do think for like an A plus asset, um, the leverage is still pretty high, like in the 4.5, 5 range. Depends on the industry, obviously, and the size. But so I think for the very best companies, the leverage is still pretty robust. I think it comes down quicker if it's more of like a B company or has some concentration or whatever. And so your B company that used to be a 4.5 maybe is now is kind of a 4 to high threes of total debt, just given kind of where we are in this cycle, I guess. So that's what we're seeing.
All right, so let's put on a hypothetical scenario that you guys are out to bid uh, for an asset. What the average enterprise value of an asset that you guys are buying was like 35 million, 30,
Yeah,
35.
I'd say 35, 40. Yeah.
Okay, so let's say $40 million asset. You guys are super excited. This is the most you'll pay for it. Um, you know that there's 5 other guys or girls that are out there with the exact same dollar bid, exact same compensation plan for the partners to stay on. Terms are the same, right? You did speak a little bit about, you have an in-house talent officer who's going to help them help get sales guys, executive team members, etc. What's your guy's special sauce that makes you win the deal over someone else doing the exact same thing? Look,
Yeah.
it might be another SBIC firm, right?
Yeah.
So,
No, great question. I mean, I know it's hypothetical, but we're living this every day. And actually, next week we're flying down to a company to pitch exactly this against probably much bigger funds. But so what we kind of lead with is a few things. Our longevity in this market, I think, resonates pretty well. We're often competing. If it's a small company, we're often competing with kind of a spin out or a startup fund or maybe a fundless sponsor. So I think the thing we try to highlight first and foremost is we've been doing this for a while. We love this size and type of deal and partnership. We think we're okay at it, and getting better every day, hopefully. But you can call 30 CEOs that Paul and I have worked with as references at RFE that can give you some comfort as to how we operate. And so I think that compared to some startup or spin out funds, that in itself hopefully helps our angle a bit. I think secondly, our low debt approach is a bit unique. And so we say, look, we may not be the highest bid, but whoever the highest bid is going to have a boatload of debt on your books day one, and we will not. And that's a huge it's a huge flexibility gain, liquidity gain in year one, and it's just a better way to live in our minds. We can hire the right people around you. We can do the right add-ons. We can do systems, whatever we want to do. We can't go bonkers and have EBITDA drop like a stone, but we want to have the flexibility to do all the right moves for the company without debt on your books. And I guarantee you other bids will have mountains of debt. I think our add-on history is a good one too. I think if it's an add-on play, we can point to our volume of add-ons as being a differentiator. I think we've got a very proactive, aggressive, constant add-on approach that's maybe not that unique, but it's something we've kind of refined over many, many years. And I think we've done probably about 40 add-ons in the current fund and over 200 in the firm's history. And so if it's an add-on type of play, we can sort of speak to our experience there and lending a hand on M&A and all things sort of build up as a differentiator. And I think the other piece that you mentioned, Zev, is just the chief talent officer and how we're never going to parachute in an operating partner to look over your shoulder, be half in, half out, tell you to raise prices and then go on vacation for 3 weeks and come back and, tell you to cut costs and then go away. And so we've just seen that model backfire with these size companies. And so we're trying to, when we're talking to the seller or the CEO, or usually one and the same, we will support you. We will add industry folks to the board who can give you perspective. We're going to help you build out your team, but we're not going to have that sort of over your shoulder operational oversight that you don't want or need. And that alone, I think, has won us some deals in the past, because a lot of our bigger competitors have that model, which I know works great for them, and it's obviously a very compelling value add for a lot of the PE community, but just not how we do business. And so that's kind of our last differentiator. And so, that's kind of how we think about it.
Well, last question from me. From my perspective, we work with a lot of ultra high net worth families, but then we also have some financial institutions that are our clients. Your deals, obviously banks like to have the CRA credit. Where is it that you guys are really focusing for deploying capital? Is it Northeast, right? Because you guys are located in the Northeast, but then you also have some presence in Florida, but you're not really a Northeast and Florida only shop. So how is it that people should be thinking about you in terms of where is it you guys are going to be visiting often?
Yeah, so we are nationwide. I think a vast majority of our deals are eastern half of the U.S. We've got our last deal happened to be in L.A. I'm actually going to L.A. next week for something else. So for whatever reason, California is popping up a bit more. But yeah, I think we attract a lot of executives to these companies. So where they are matters from the perspective of, can I attract a great executive to the city? And we have a company in Austin, which we had to hire 4 or 5 people, but Austin's a huge selling point, so that made it easier. And we got a lot of stuff in Florida for obvious reasons. As you know, Zev, Florida's a nice place to be. And so the company's in Tampa and Boca, and we got one in kind of outside Palm Beach, where it's been a nice draw to build the team in those nice cities. And so I think we're certainly pretty agnostic as to what geographies we go to, but it's a huge plus to find a company in a desirable location, which happens to be Texas and Florida these days, in terms of building the team and attracting talent. But we are nationwide, and we've seen things in all different states. So
yeah, it's probably also how other, like, the bigger firms that you're looking to sell into, right, as a majority of your exits,
right?
They're probably looking for the same thing.
Yeah. And we've met great companies in states where it's just hard to get to, and it's like a 2-hopper flight and 2-hour drive, and nothing against their town or their business. It's fantastic. But I've been upfront with them, like, look, it will be hard for me to recruit people to this company given just where it is. It's not in a town that are, people are flocking to. So, but yeah. We're very opportunistic on location, but that element needs to sort of fit in terms of, can we attract people here?
I know you're working on fundraising for the current fund. Obviously, I'll give everyone in the description of this podcast, there'll be the link to your guys' website. Anyone could reach out to me to reach out to you. But anything else you wanted to leave people with?
No, I appreciate the time, Zev. This has been great, and we are kind of on the first rounds of raising Fund 10 with the first close this fall. And it'll be, like I said, a very similar size and approach and structure to Fund 9, which we think is going very well. And so happy to meet with whoever wants to meet and say hello and tell you about RFE.
All right, perfect. Well, thanks, man. I appreciate the time.
Thank you, bud. Appreciate it.
The information presented in this podcast is the opinion of Sierra Capital and does not reflect the view of any other person or entity. The information provided is believed to be from reliable sources, but no liability is accepted for any inaccuracies. This is for information purposes only and should not be construed as an investment recommendation.